Where does your money actually go? Investing becomes much clearer when your money has a destination, not just a price. Banks by design are conservative institutions. Most people think investing is just numbers on a screen, but there is a more important question. Where does your money actually go? Behind every return, there is a real economic activity, and one group sits at the center of that activity: small and medium-sized businesses, often called SMEs. There are companies that form the backbone of most economies: local manufacturers, logistics companies, construction firms. Also, service providers, family businesses that employ dozens of hundreds of people. But despite their importance, many of these businesses still struggle with one basic thing: access to capital. Not because they are bad businesses, not because they don't have demand, but because traditional financing models are built in a very specific way. Banks by design are conservative institutions. Their primary responsibility is to protect their balance sheets and manage risk. So when economic uncertainty increases or when market conditions change, banks tend to tighten their lending standards. They become more selective, more cautious. And the first companies that feel this tightening are often SMEs. A company may have a healthy business model, steady demand, and real customers, but it may still not perfectly fit the strict requirements of traditional bank lending. Sometimes the company is growing too fast. Sometimes the sector is considered too dynamic. Sometimes the business is regional or niche, and sometimes the timing simply doesn't match the internal process of large financial institutions. As a result, a funding gap appears, a situation where real businesses need capital to grow, but traditional channels become harder to access. So the natural question becomes: if bank credit becomes more selective, what fills that gap for businesses that still need financing? This is where alternative financing models begin to play a role. One of them is crowdlending. Crowdlending is a relatively simple idea. Instead of a single bank providing a loan to a company, a group of investors collectively provide capital. The business receives financing that it can use for real operational needs, and investors receive interest payments as the business repays the financing over time. In other words, the flow becomes very transparent. Investors provide capital. The business uses that capital to operate and grow, and the business repays the financing with interest. Compared to many investment products that feel abstract or distant, crowdlending is relatively easy to understand. Your capital goes to a specific company, a specific project, a real business activity, and that's where the idea of social impact investing starts to become more concrete. When people hear the phrase social impact, they sometimes imagine charity, but that's not really what we're talking about here. Social impact investing simply means aligning your investment with real-world outcomes you can actually understand. Your capital goes somewhere tangible. It supports a real economic process, and in return, you receive a financial return generated by that activity. In crowdlending, impact is often very practical. Financing may allow a company to purchase equipment, to secure raw materials on time, to expand product capacity, to upgrade logistics, or simply to maintain healthy working capital so that operations can continue smoothly. Sometimes the difference is surprisingly simple. A business can fulfill larger contracts because it can buy materials earlier. A factory can upgrade machinery and increase output. A logistics company can scale operations without losing demand. And from the investor's perspective, sometimes important happens as well. your return becomes linked to real operational reality, not just to market mood, not just to speculation, but to the performance of an actual business activity. That connection between capital and the real economy is one of the reasons many investors are becoming interested in models like crowdlending, because the logic is visible. You can follow the project, understand the business, and see where capital is going. But there is another layer of impact that often doesn't get discussed enough: community. When investors begin to analyze projects, discuss them, and follow the process of businesses they support, something interesting happens. A more transparent ecosystem starts to form, more information flows between participants, more accountability appears, and there is greater awareness of the role that small and medium-sized businesses play in the real economy. Instead of being invisible parts of the supply chains, these companies become visible participants in an investment ecosystem, and that creates healthier dynamics for everyone involved. Of course, it's important to say something very clearly: no investment is without risk. Social impact does not remove risk. Every investment decision requires analysis, discipline, and diversification. The real measure of a platform is not marketing language, it is process. How projects are selected, how information is documented, how transparent the structure is, and how clearly investors can understand the mechanics behind potential returns. Because ultimately, a good investment should always be explainable. There is a simple rule many experienced investors follow: if you cannot explain where the yield comes from, then you don't really own an investment. You own a story. And the goal of platforms operating in the crowdlending space is to make that explanation as clear as possible. One example of such a platform is Maclear. Maclear's approach is built around a simple idea: connecting investors with real small and medium-sized businesses that need capital to grow, especially in situations where traditional financing may be limited or slower to access. For investors, the model is straightforward: real companies, clear terms, visible projects, and a structure where capital participates in real economic activity. If you're curious about how this works in practice, one useful step is simply to look at real borrower stories. Many platforms publish interviews with businesses that explain how financing was used and what changed as a result. Not as marketing slogans, but as practical case studies. Because the most important thing in investing is not believing a narrative, it's understanding the mechanics, where the capital goes, how the business uses it, and how the return is generated. So a good starting point is always the same: take one project, study it carefully, understand the business, understand the structure, and then decide whether this type of investing fits your own strategy. Because in the end, investing becomes much clearer when your money has a destination, not just a price. Follow this channel for more educational videos and don't forget to hit that like.